All right, dear students, now we are doing practice of the consolidation. And as you can see, this is March, June 2021. So this is March, June 2021, taken from the ACCA's website. So you can also see this question in your Education Hub practice platform. So the practice study hub practice platform. So you can see this question over there. And we know there's a practice platform. There's a blank workspace over there where you can practice the questions. So this is on 1st January to, okay, let's go to the requirement first. Requirement is, where is that? Yes. The requirement is calculate the goodwill arising on the acquisition of silver company. So goodwill arising on the acquisition of the silver company. We need to calculate the goodwill. And we know that working number 3 belongs to the goodwill we have studied within the consolidation. But for working number 3, we need to do the working number 2 as well to calculate the net assets of subsidiary at acquisition, and then working 2 will lead to the working number 3. And then we have this: prepare the consolidated statement of the profit or loss for gold company for the year ended 30th September 20x2. And you can see this is the spreadsheet that you will be having in your exam, where you will be doing all these workings and preparing the consolidated statement of the profit or loss. So let's go back to the question. Okay, the question starts from here. On 1st January 20x2, remember I said in the consolidation, you need to see the dates. So the statement of profit or loss is being prepared on 30th September 20x2. We know that a year which is ending on September starts on October. So 1st October 20x1 to 30th September 20x2. And it is not starting from October. It is starting from 1st January 20x2 to 30th September 20x2. So these are the 9 months. So this is mid-year acquisition. This is mid-year acquisition, and that means 9 by 12, months by 12. So here the fraction is going to be 9 by 12. So on 1st January 20x2, gold company acquired 90% of the 16 million one equity, $1 is the par value, equity share capital of the silver company. So gold acquired silver. Gold is the parent company, silver company is the subsidiary. 90% of the 16 million. So that means their total shares are 16 million and they've acquired 90%. So as they're taking the working in the 000, so that means the shares would be 16,000, doing all the working in 000 into 90%. So let's use the calculator as well. Okay. So 16,000 into 90%. So you get 14,400. So the number of shares that are being acquired is 14,400. Okay, so this is the number of shares acquired. Okay. Gold company issued 3 new shares in exchange for every 5 shares it acquired in silver company. So we know this is the share exchange. We know this is the share exchange. So we know the share exchange, how it is being calculated. So we have the formula for it, number of shares acquired. So we already know it is 14,400. So how we calculate this share exchange is simply 14,400 number of shares acquired multiplied by the fraction. It says 3 new shares for every 5 shares. The fraction would be 3 by 5. and multiply by the parent share price. We need to see that how much it is. Okay, gold companies. Okay, so we are done. Additionally, gold company will pay further consideration on 31st December 20x2. They have acquired the company on 1st January 20x2. And they will be paying further consideration on 31st December 20x2. That means after 2 years. So this is deferred consideration. So as we have studied in the consolidation, that if the parent company will be paying in the future, this is known as the deferred consideration. And we have a formula for it. Present value equals to the future value, 1 plus r raised to power minus n. So it says, additionally, gold will pay further consideration of 2.42 per acquired share. So 16 million are the total shares. We have acquired 90%, taking in the 000, it is 14,400. So that means future value would be 14,400, which is the number of shares acquired, multiply by 2.242. And then we need to multiply by this 1 plus r raised to power minus n. Gold company's cost of capital is 10% per annum, and the discount factor at 10% for 1 year is 0.909. So it is 1st January 20x2, and they're going to pay on 31st December 20x2. It is 1 year, sorry. So it's 1 year. So they have already given the discount factor. There's no need to calculate it. So we just need to multiply it by 0.9091. The examiner has made this thing simple. So 14,400 multiplied by 2.42 multiply by 0.9091. So it is 28,800. So you can check it as well. So 14,400 multiply by 2.42 multiply by 0.091. So 14,400 multiply by 2.42 multiply by 0.9091. Sorry, my bad. It is 31,680. Thank you. So this is 31,680. So this is deferred consideration. And obviously we are not supposed to use the calculator in the exam. There would be a spreadsheet where you can just simply do all these things. I'll show you in a while. Right now I'm explaining you how it is being calculated. That is why we're using the calculator. Okay, but even in the exam, you have the calculator. You can use it from here. So scratchpad and the calculators. Okay, the share exchange was 14,400 number of shares acquired multiplied by the fraction. Now we need the parent share price. At the date of acquisition, the shares in gold company and silver company had a fair value of 8 and 3.5. So that means the share price of the parent is $8. Now we can calculate the share exchange as well. 14,400 into 3 by 5 into $8, which is the share price of the parent. So again, 14,400 into 3 divided by 5 into 8. It is 69,120. So we are done with this paragraph where we have calculated the share exchange and the deferred consideration. All these things must be done on the spreadsheet, but I was explaining you, so that is why I have done over here. So mid-year acquisition 9 by 12, the revenue of the parent is 103,360. When we take the subsidiary 6,800, we multiply it by 9 by 12. Remember, all the things relevant to the subsidiary will be done 9 by 12. So revenue, cost of sale, gross profit, distribution cost, administrative expenses, investment income, finance cost, profit before tax, income tax, and then we have the profit for the year. Now we have the additional information, which is very relevant for the question, very important as well. At 1st October 20x1, the retained earning of silver company were 56 million. Now, obviously, to calculate the net assets at acquisition, we need the retained earning at acquisition. And they say at 1st October 20x1, the retained earning of silver company were 56 million. 1st October 20x1. And we have acquired on 1st January 20x2. So that simply means that we need to take the retained earning at 1st October 20x1, which is 56,000, taking in the 000. And then we need to add the profit from 1st October to 1st January. So October, November, and December. So this is actually a 3 months profit that we need to add into the retained earning at 1st October. So you see the profit for the year of the subsidiary is 9920. So you take 9920, 9920 and multiply by 3 by 12, which is October, November, and December. And then you will get, this is the retained earning at acquisition. So very simple thing. So 9920 multiply by 3 divide by 12. So it is 2480 plus 56,000. So it is 58480. And again, this is what we do on the spreadsheet. At the date of the acquisition, the fair value of the silver's company's assets were equal to their carrying amounts, with the exception of 2 items. So that means other than these two, all the assets carrying value were equal to their fair value. And these 2 assets are an item of plant had a fair value of 2.6 million above its carrying amount, which is the upward fair value adjustment. And we know that we need to take it. The remaining life of the plant at the date of acquisition was 3 years. And this is for the fair value depreciation. So what we're going to do is to calculate the fair value depreciation is 2600 divide by 3 multiply by 9 by 12, because everything related to the statement of profit and loss subsidiary should be prorated. So 2600 is the fair value adjustment, and then obviously divide by 3, which is the useful life, multiply by 9 by 12. So make sure you are doing all these things by yourself as well. Silver company had a contingent liability which gold company estimated to have a fair value of 8,50,000. This had not changed as at 30th September 20x2. Now this is another concept, and I told you when we were doing the consolidation that if there is any liability which is not recorded, must be recorded now on the consolidation. And there is a rule that the contingent liability of the subsidiary becomes a liability in the consolidated financial statement. Although in the individual financial statement, it is still being treated as a contingent liability. But when you're doing the consolidation, it is being recorded as a liability. So again, we will be taking that in the working number 2. Silver company has not incorporated these fair value changes into the financial statement. So we are supposed to do that. Gold company policy is to have the fair value at non-controlling interest at fair value. I told you in the exam, they are going to tell you whether the proportionate method or the fair value method. So it's a fair value method. For this purpose, silver company share price at that date can be deemed to be representative of the fair value of the shares to be held by the non-controlling interest. And I told you, so you take the shares, multiply by the NCI percentage, multiply by the fair value of the share of the NCI. So here they say you can use the subsidiary share value as the NCI share value, which is already given. So number of shares are 16,000. NCI percentage is 10%. And the fair value is being given in the question. It is $3.5. So we will have the fair value of the non-controlling interest at acquisition. Simple. We need that because we need to put that into the goodwill calculation. So this is how we do it? 16,000 is 10% is 1,600 multiplied by 3.5. So it is 5,600. So simply NCI at acquisition is 5,600. Sales from the gold company to silver company in the post-acquisition period had consistently been 600,000 per month. So when we calculate the total sales, as we need to reverse the sales, intragroup sales, as well as the intragroup purchases from the revenue and the cost of sales. So it is 600 into 9. So remember, this is how we're going to do it. So 600 into 9, 5,400, yes. So 5,400 would be removed, 9, 6 of 54. 5,400 would be removed from the intragroup sales as well as the intragroup purchases. Gold company made a markup on cost of 25% of these sales. Silver company had 1.2 million of these goods in inventory as at 30th September 2022. Now we know that to calculate the unrealized profit, we need to know how much of the goods are in stock, and it clearly says 1,200, which is 1.2 million. So 1,200 divided by as its markup, 125, 100 plus markup, and multiply by 25. So this is, we get the unrealized profit. 1,200 is the value of the inventory still in stock. Divide by 125 because there is a 25% markup. So this is the sales value. Multiply by 25. So we get the unrealized profit of 240, which will be adding back in the cost of sales because we need to reverse it from the intergroup purchases. So 5,400 will be deducted, 240 will be added. Gold company's investment income is a dividend received from its investment in a 40% owned associates in which it was held for several years. Associate made a profit of 3 million for the year ended 30th September 20x2. So we know how to calculate the share of profit from associates. So it is simply given the associate's profit. You see, I told you that you need to see whether it's the associate profit or the parent share of associate profit. The associate made a profit of 3,000. So this is the total profit of the associate, and the parent's percentage is 40%. So simply you will get 4, 3, the 12, 1,200. So the profit from the associates is 1,200. Okay, then we have a working relevant to the convertibles. And we know convertibles are in the IFRS 9 financial instruments. That is pretty simple working of the convertibles. So on 1st October 2001, Gold Company issued $100,000, 100. So 100,000 is the number, $100 is the nominal value, 6% is the nominal rate. Convertible loan notes at par value, with interest payable annually in arrears in over a 5-year term. The equivalent rate for non-convertible loan was 8%. So this is the market rate. Gold Company has recorded the loan notes as a liability at par value and charged the annual 6% on the finance cost. And we know that as per the IFRS 9, which is the amortized cost working of the loan, I'm just writing it. I will not explain it because this is just a revision. You already know that from the IFRS 9 lecture. We take the opening balance, which is the present value of the debt. We add the interest rate on effective rate, which is the market rate. So according to this question, interest should be charged on 8%. 6% is the nominal amount that is used for payments. 6% is the nominal amount which is used for the payments. So they have, they have done the mistake over here, an error. So the payment is being deducted. So we take the opening balance, add interest on effective rate. Payment is done on the nominal rate, and we get the closing balance. So this is the error they have made over here. It says Gold Company has recorded the loan notes as a liability at par value and charged the annual 6% interest rate to the finance cost. Now we need to calculate the interest, how it would be according to the 8%, and then see the difference, how much it is not recorded. The 2% is not recorded, but now we need to see how much that 8% is, because we already know the 6%. we already know how much is the 6%. So 6% is this 100,000 is the number of the loan notes, multiplied by the $100, which is the par value. So that is become the total convertible loan notes multiplied by 6%. So that simply means the interest payment. So you see 100 is the par value. How many loan notes are there? 100,000 loan notes are there. So that simply means 10 million, right? 10 million is the total par value of the convertible loan notes. So if we take that in the 000, so that would be 10,000. Now 10,000 into 6%, that is the payment, 0.06. So 10,000 into 0.06. So it is 600. So 600 is the payment. Now we need to see how much is 8%. So that we calculate the difference between the 6% and the 8%. For that, we need to know the convertible working. And I hope you remember from your IFRS 9. From IFRS 9, the convertible working. Let me just do it over here. Yes. Convertible working. It was a plain format and it was a very easy working that first of all, you take the years and it says how many years are there. Interest payable annually in arrears for 5 years. So the good thing is that they have given us the annuity factor, which is 4.212. 4.212 on 6% and 8%. But remember that when we are discounting, the nominal rate is irrelevant. The discount factor which we take to calculate the present value of debt is this one, which is the market rate. So in the year 1 to 5, there would be a cash flow. And how much cash flow it would be? 600. Let me write the format for you as well quickly. So the format is we take the years. So say 1, 2, 3, and then we take the cash flow. In the year 1, it is in interest payment on the nominal rate. In the year 2, this is the interest payment on the nominal rate. In the year 3, it is the interest payment on nominal rate plus the principal amount. Then we take the discount factor. Remember, always we take the discount factor on the effective rate, market rate, effective rate. And then we get the present value. This is the present value of debt. Okay, now we can simply do it. If you are not aware of this, you can just refer back to the IFRS 9 convertible calculation, which is very easy. So then we take the discount factor. Discount factor, because from year 1 to 5, the cash flow is same. So we're not supposed to write 1, 2, 3, 4, 5. We take the annuity factor because if there's the same cash flow for a number of years, specific number of years, we take the annuity factor, which is 3.993. And so this will be in the year 1 to 5. And then in the year 5, there would be the principal amount, which is 10,000. That would be returned. So that is in the 5th year, discount factor is 0.681. So yes, we can just simply do it. 600 into 3.993. So it is 2395.8. So we just round up 2396. And then we have this thing, 10,000 into 0.681. So it is 6810. So 6810 plus 2396. So this is 9206, which is the present value of debt. And the difference between the 10,000 and the 920 is the equity, but we don't need that thing over here. But obviously we may need in any other questions or just explaining you for the concept that if we take the total value of the convertible, which is 10,000, and compare it with the present value of debt, the remaining is the equity portion, which is recorded in the other components of equity. So this 9206 is the present value of debt, which is now comes under the amortized cost working. So 9206 multiplied by 8%, because this applies over here, which is 736. So interest is 736 less the payment, and then we get the closing balance. Now see, the 736 was the expense, which should have been recorded, but they recorded 600 as an expense. So the additional expense that should be recorded now is 736 minus 600, which is 136. So this is how we do it. 136 should be recorded in the finance cost. No impairment in the question, so that's a good thing to know. Profits accrue evenly through the year, so that is being given because we can do the pro rata thing straight away. And we have this requirement. So first of all, let's calculate the goodwill. So you will be having spreadsheet in the exam. Here we are doing on Excel. You can also practice on the practice platform. So remember that we are doing the working in the 000. So don't forget to mention the dollar into 000 because you're doing the workings in that thing. So first of all, we have the consideration. Now in this example, we have the consideration. Going back to the question. So we have the consideration. One is the share exchange, and other is the deferred consideration. So first of all, we have the share exchange. So yes, the formula starts with the equal to, and the total number of shares is 16,000, as mentioned in the question over here, 16 million shares, and they acquired 90%. So what you do is 16,000 multiplied by 0.9, which is 90%. So now we get the number of shares acquired. Then we multiply it by the fraction. The fraction is 3 new shares for every 5 shares. So that means 3 divided by 5. And then multiply by the parent share price, which they have mentioned clearly is $8. So you get this 69,120 as the share exchange. Now you do the deferred consideration. And there's one more thing, obviously, you need to see where you are giving the exams. Whether, obviously, when you practice on your own, you're using the laptop, and the laptop keyboard is quite different from the one we have in the CB Center, that is the keyboard. So laptop keyboard is different from the other keyboard. So make sure if you already know where you're going to appear, just use an external keyboard to practice these things so that in the exam you can ensure the speed. So right now I'm using my tablet, and this is not my usual laptop, which I use for other Excel things. So this keypad is different from my other laptop as well. So that this is very important to understand that for the exam, make sure you're practicing on the same thing. So deferred consideration is, again, the 16,000 is the full complete number of shares. We acquired 90% of it. And it says that you are going to pay 2.42 per share. So this is 2.42, and then multiply by this factor, which is 0.9091. 0.9091. So you get this thing, 31,680. Okay, this is the deferred consideration. We are not going to take the decimals, ignore it. Okay, then we need to add the non-controlling interest. And they say non-controlling interest is calculated at the fair value. We have already done that. This one. So again, you need to show the examiner how it is being calculated. So 16,000 is the number of share total. The share belongs to NCI is 10%, which is 0.1. And they say that you take the subsidiary share price for that, which is 3.5. So multiply by 3.5 and you get this 5,600. And then you need to deduct the net assets of subsidiary at acquisition. So we can do the net assets working as well. Net assets of subsidiary at acquisition. So again, doing that in the $000, make sure you do that accordingly. So first of all, we take the equity shares of the subsidiary that is being given already 16,000 because the par value is $1, so it is straight away 16,000. There is no share premium. So we have the retained earnings. But remember, the retained earnings which were given was on 1st October. So it says in the question, the retained earnings were 56 million on 1st October, and we need on 1st January. So we take 56,000 plus the profit for the year, which is 9920, multiply by 3/12, we need to add it. So it is 58,480. Okay, then we have the fair value adjustments. It says the fair value adjustment is 2.6 million, 2,600. We are not supposed to show the depreciation impact because that is being done on the reporting date. Okay, so then again, if there is any unrealized profit, that belongs to the reporting date. But there was one thing which was the liability not being recorded. So which is the liability that we need to record. So liability is shown in the negative, which is 850. So this is how we do. Okay, so you start with the equal to sum, open the bracket, and we need the sum from here to here, and press enter. This is 76,230. So now we need to deduct the less than net assets at acquisition. Don't write NA, write full in the exam, net assets at acquisition. We need to deduct this, start with the equal to sign, press minus, and we link this here. So now we can calculate the goodwill on acquisition because there is no impairment. Goodwill on acquisition. So starts with the equal to sign. You need sum from here to here. And the goodwill is 3170. We are not supposed to take 0.32. So this is how you are going to do the question in the exam on the Excel. So just give you the flavor that how it is being done. Okay, now when you're supposed to make the statement of the profit and loss, okay, let me just show you directly over here. Yes, this is. So for example, you're making the statement of profit and loss, don't write SOPL, write full statement of profit and loss for the year ended, blah, blah, blah. Consolidated statement of profit and loss for the year ended 30th September. And again, we are supposed to do that in the 000. So first of all, we will be having the revenue. Now, again, we need to show all the things over here. Revenue. Okay, revenue is of the parent. How much is it? Is 103,360. 103,360. Okay, then we need to add the subsidiaries revenue. Subsidiaries revenue is 60,800, but we need to do the months by 12. So brackets on. 60,800 multiply by 9 divide by 12. And then we need to deduct the intra-group sales, which we have already calculated. So it was 600 per month into 9 months is 5,400. So we deduct 5,400. So we get 143,560. This is how we do it. Similarly, we have the cost of sales. Okay, if you feel there are a lot of things within the cost of sales, you can do the separate working for the cost of sales. Otherwise, you can just show in the cell as well. That's completely your choice. So the parent's cost of sales, again, if you're doing like this way, so again, dollar into 000. So you can choose your way how to do it. So parent's cost of sales is 81,920. So 81,920. Now you take this, don't write parent, write the name of the company. So subsidiary. Okay, so it is how much? 41,600 but we need to take months by 12. Multiply by 9, divide by 12. So it is 31,200. Got it? Okay, then we need to deduct the intra-group purchases. The more you practice, the more you get it done quickly. So intra-group purchases will be deducted. So 5,400 minus. Okay, then we have the unrealized profit, which we have calculated. You can show the unrealized profit calculation over here as well. So that means 1.2 million, 1,200, again, unrealized profit is going to be added back. 1,200 was the value divided by 125 into 25. So 240, you can simply show examiner when they see the cell, they will see, okay, this is how you have done the calculation. Right, got it? So this is how you do it. Okay, then we have the fair value depreciation. So the fair value adjustment was 2,600, divide by 3, multiply by 9, divide by 12. So now we can see the total. So the total is 108,610. So what you can do is simply press equal to minus sign and press enter over here. So in this way, for example, even if you miss something, for example, if you miss the depreciation from it, and later on you remember, okay, I need to include the depreciation. So if you make any changes over here, that will be shown over there as well. So this is gross profit. And again, we know how to do it. So we use some formula and brackets and here to here. So you get 34,950. And then you take the administrative expenses, and then there's distribution costs, and then the share of profit from associates, the finance cost. So this is how you do the question of the statement of profit or loss.